Limited entity acquired 80% equity shareholding in Paper Limited, another public limited entity, on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 1,331 million deferred until 1st of April 2026. This is what we refer to as the deferred what? Consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. 𝐿𝐿𝐿 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐿𝐿 Limited, together with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of 𝐶𝐶𝑠 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for 3 companies, 𝐿𝐿, Paper, and 𝐶𝐶𝑠. We have the statement of financial position for the 3 companies, that is 𝐿𝐿, Paper, and 𝐶𝐶𝑠. And then we have some additional information. This was actually one of the simplest questions, which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? At A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. To come up with a group structure. That's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called Paper, a public limited company, on 1st April 2024. So the company which is called 𝐿𝐿 Limited, this company acquired 80% equity shareholding in a company which is called Paper Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿𝐿 is the parent and then Paper is the subsidiary. You can see also we're given the date of acquisition. Then from there, once we go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿𝐿 Limited, our parent company, with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of what? Of 𝐶𝐶𝑠 for an immediate cash payment of 15. So this company here, we are told acquired 50% shareholding in a company which is called 𝐶𝐶𝑠 Limited. 𝐶𝐶𝑠 Limited, on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐓𝐿 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary. Paper Limited net asset approximated their carrying amount with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of CSAS. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. Revalued the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually, we said once the subsidiary company revalue the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which you are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by Paper Limited. By Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment. And basically, this is the adjustment in relation to the revaluation gain or loss. But remember, you see, in most of the questions for group account, you will come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of Paper Limited net asset approximated the carrying amount with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by Paper. Did the Paper Limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number 2, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we say in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. depreciation other charge, and equally this depreciation other charge will be by paper, is by paper limited. So you need to recall the formula. There is a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April, 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what year? We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful price. And I hope you can see that within note 1. Can you see the remaining useful price? How many years? In note 1, remaining useful price. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful price of that asset. Can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here. We had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested in the depreciation other charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation other charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation other charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation other charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation other charge. Let's move to point number 2, where we are told 𝐎𝐿𝐶 Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained that if you come across that information that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, that information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. The full goodwill what method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCI fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to Rock Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to Rock, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by Paper to Rock, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiary are fixed sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of sales. Group revenue and also group cost of what? Of sales. So then in the same point, we are told half of these goods were still held by Rock Limited as at the end of the year, and the balance payable was still outstanding, and the balance payable was still what? Outstanding. Now, in that case, we have 2 adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us, first of all, we deal with we compute the amount of unreleased profit, amount of unreleased profit. So unrealized profit on inventory. Remember, unrealized profit, we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Lock, but basically some of the goods remained in the inventory of Lock. They were not yet sold to third parties. We need to compute the unrealized profit, and this unrealized profit is always by the selling company. The selling company is this one. So this is unrealized profit by Paper. So how do we compute this unrealized profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit basically by applying this formula here. We will take the unsold goods. And in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Rock. The unsold goods will be half of the goods which were sold by Paper to Rock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question, we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20%. As a fraction, it will be equal to what? As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1/5. So this one will be, the margin will be 1/5. So how much will be our unreleased profit here? So it will be half to 50, and basically that will be 50 million. So this unreleased profit number 1 This will be deducted from the group inventory. In preparing our consolidated balance sheet, we let's start from the group revenue. Number 2, this one will also be deducted from the retained earnings of the selling company. The selling company is paper. That one will be deducted from the retained earnings of paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. To the group cost of sales. Those are the 3 adjustments which will be made as far as that and his profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here will be 500,000, 500 million, that is, because the amount of money which 𝐎𝐿 Limited was supposed to pay paper was 500 million. So this amount is the one which amount to, or which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically reveals that both goodwill on acquisition and on paper limited and the interest in CISA were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no awarding which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis, or something you need to apportion, you apportion it on time basis. You apportion it on time basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition, because there is something we will compute there. Then first of all, we compute the goodwill on acquisition of this company here. Remember, I said we only compute the goodwill on acquisition of the subsidiary, and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill. The goodwill on acquisition of this company, that is paper, paper limited, and as per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, So here we need to have 2 columns, and our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2. Paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in two forms: the cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount, we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the statement of financial position of the parent, under the non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 31 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and 𝐓𝐿 Limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331, and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition? 1st of April 2024. This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have 2. We have the first year which will end first, or basically 1st April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take 1. Remember the formula here: 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay, so then this is basically the purchase consideration paid by the parent. And then now to this, what do we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values so that then we proceed and we less the net assets, which one? Acquired. And basically, I'm told that this one will give us 4360. 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. Plus pre-acquisition reserves. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if we are given a share premium in the balance sheet of the subsidiary, and the question is silent, the question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically, what we know is that that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. This is a reserve. We're interested with the retained earnings on the date of acquisition. And basically, what we know, I've said that the retained earnings which are given there of 1,800, this is the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings of this date. So can we be able to get this? Take into account to get this, we take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1,800 minus 520. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, we don't have any other reserve. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there revaluation gain? Remember here, Paper Limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI. Parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. We get the goodwill. So our goodwill will be what? Will be 320. Now, also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, the goodwill was not impaired. So I think having this now, I want us now we prepare what we are required. And because we have now the workings, all the workings, basically to prepare what is required should not take us a lot of time. So we go straight to part A, the consolidated statement of profit or loss. Let me just have that here. The consolidated statement of profit or loss, which is for the year, which ended 31st of March 2025. 31st of March 2025. Yes, so here we just need to have a single column, and basically we indicate that our figures are in million of shillings. So how do we prepare this? As per our group structure, we are basically combining the revenue and expenses of the parent, those of the subsidiary. We combine the revenue and expenses of the two companies. It is also important to note that this company, taking into account it was acquired exactly the start of the year, we will take the revenue and expenses of paper for the whole year. we combine with that of the parent. In our case, remember, we don't consolidate a joint venture. Instead, what we will compute is the parent company share of the profit after tax, and basically we recognize it what here. So let's do that now. So how to prepare this, we go to the statement of profit or loss for individual companies, which is basically given below paragraph 2. And we use the format which are given here. So we will start with the revenue. We take that of the parent, 520, plus that of the subsidiary, which is paper, 51 what? 80. So remember, we are not consolidating their joint venture. So and then to this, what do we need to do? We need to less any sales between the parent and the subsidiary. And I hope you can remember you have this intra-group trading of 500 million. We less it here. No any other adjustment. No any other adjustment. We get the final value. We try to hurry up so that we finish. Although I can see we have time. We have time. So once you get the answer, type it in the chat box. I'll be able to see it. So I'm told that will give us 13,200. 13,200. Someone else to confirm. Is it 13,200? Is it 13,200? Is it 13,200? Yes. So then below that, we take the cost of sales. We do the same. 5510 plus 3440. So to this, we have a number of adjustments to be made. One, we less this amount of intra-group trading, 500. So we also have this depreciation. Okay, this one will not be adjusted to the cost of sales, but rather to the administrative. We have this and this profit of 50 to be added there. And I don't think we have any other adjustment. So we get the final value there. The final value. Final value, I'm given 85. I'm given 85. Okay. So we move and basically we compute the gross profit. So the gross profit here will be how much? How much will be our gross profit? The gross profit will be 47. So then to that we proceed and basically we add the distribution. I think before we add the distribution, we can do this. We need to compute the group share. The group share of Sisters Limited profit after tax. Remember, this is basically a joint venture. That's what we include here as far as the joint venture is concerned. So what we need to do, can we go to the income statement, to the statement of profit or loss of Sisters, and you give me its profit for the year or the profit after tax? The profit after tax for Sisters is how much? Is it 640 million? Yes, 640. Now, then we need to determine when was our joint venture acquired. You can see the date when it was acquired, this date here. 1st of October 2024. This is within the current year. The current year is added, the current year added on the 1st of March 2025. How many months do we have here? Are they 6? So we have October, November, December, January, February, March. 1, 2, 3, 4, 5, 6. So in this case, we have how many months? Yeah, are they 6? Are they 6 months? Do we have 6 months? I've said 1st of October 2024. So our joint venture was acquired 6 months to the end of the year. So the parent company will only be entitled to share profit from the date it acquired that joint venture. It will only be entitled to share profit for how many months? 6. That's why we have to compute profit of 6 months, and then we multiply that with the parent company shareholding in Sisters, which is 50%. That gives us now the group share of Sisters Limited profit after tax. You think this one should be 160. This one should be 160. And then from there, let's proceed with the expenses. The first expense we have there is the distribution cost. And I hope you can be able to recall that if you come across these always have 3 mark. no single question for group accounts will come across whereby the distribution cost is to be adjusted. This is always a free mark. We take 830, that of the parent, plus that of the subsidiary. No adjustment. We get the total, which will be 1,300. Which will be 1,300. Are you getting that? Yes. So then below that, we have the administrative expenses. Administrative expenses, we check that of the parent, 860, plus that of the subsidiary, 520. And then to this one, we have to add this depreciation other charge of 70 over 70. Also, in case our goodwill was impaired, in case this goodwill was impaired, any impairment loss for the current year, we also include it within administrative expenses, but we don't have any impairment loss. We get the final figure, which will be what? Which I'm told is 1450. 1450. Is it 1450? Yes. So then below that, we don't have any other expense. Okay, there is something we will include here. That one, you have to be very, very keen to remember that. Because I hope you can be able to remember, we have this deferred consideration. You see this deferred consideration, basically this represents what the parent company would have to pay at the end of the second year. So therefore, once we have discounted this deferred consideration to its present value, we have to amortize it. In the process of amortizing a liability, there is something which arises, which is known as interest. If you're amortizing a loan, if you're amortizing even, for example, financial liability, there is something which is known as what? Interest. So that interest is basically recognized here as part of the finance cost. So the finance cost will basically be the interest on this deferred consideration. How do we compute that interest on the deferred consideration? On the deferred consideration, we take this amount which you computed here, the present value of the deferred consideration. And for us to be able to compute the amount to be recognized as an interest during the current year, we multiply this with the rate which you have used to discount, which is 10%. 10%. So this will give us 110. Now this 110 is the interest on deferred consideration. Interest on deferred what? Consideration. And then this interest basically should increase the value for this. So what I'm trying to avoid here is basically to prepare a amortization schedule, but I think I can do that very fast so that you understand. Amortization schedule. We are saying we should amortize this. You see, this is the deferred consideration at the start. This is like our own amortization schedule. You have a column for years, the liability at the start, the interest, the cash paid, and the liability at the end. No need of doing that because we know what we want to do. We want to compute the interest, which will be 10%. And then, is there any cash paid during the current year? No, no cash paid. So therefore, to compute the liability at the end of the first year, we take this plus this. Can you add for me that? So that you understand what we amortize this. So that will give us 1210. So in fact, when preparing our balance sheet, this is the value of our deferred consideration. The deferred consideration is a non-current liability, and that is its value at the end of the year. Then that would be the opening balance in the next year. And then we compute the interest, which is 10% of this. We did come to 121. Is that what you're getting? Yes. Now we know the deferred consideration, this one, will be paid at the end of the second year. So at the end of the second year, the company will pay 1331. And once you do that, then you should get 0 there. You should be able to get 0. Will you get 0? Yes. Are you getting 0? Yes. So this is how we amortize that word. That. So basically, in relation to this deferred consideration, 2 items. One, this interest is part of the finance cost here, which is 10% of 1100. And then when preparing our consolidated statement of financial position, this one will be recognized as a non-current liability. Sasa? Yes. So having that, then we can proceed and we compute the profit before tax. Give me the profit before tax now. The profit before tax down here. How much would be a profit before tax? This plus this minus the 3 expenses there. I'm told this one will be 2,000. I'm told that one will be 2,000. Will be 2,000. Then we list the other item, which is also always a 3 mark. Income tax expense. Income tax expense, also this one, is always a 3 mark. A 3 mark. So no question for group account whereby income tax will be having adjustment. You take that of the parent and that of the subsidiary. And this will give us what? This will give us 670. 670. And basically we get what? We get profit for the year. Profit for the year, which will be 680. Which will give us which will give us what? 1320. Yes. So basically in our case we are done, and that's what was required. The marks allocated there were 10. So this basically what was to give you what? 10 marks. You can see in that question, it basically means that for any correct item which you had here, basically should be 5 marks, because these 6 cannot be 10. Yes. So having that, let's move to part B. The consolidated statement of financial position. Consolidated statement of financial position is at 31st of March 2025. Okay, so we prepare this one. We just need to have a single column here. And what is basically important for you to remember is that here, or this one is basically prepared by just combining similar items of assets and liabilities, those of the parent and those of the subsidiary only. As far as the associate is concerned, CSAS, we will include something called the investment in associate. So let's prepare this one. We start with the non-current assets. So for the non-current asset, we will start with the PPE, the property, plant, and equipment. So, and basically we take that of the parent 4260 plus 3660. And then you have to recall, we have an adjustment to be made to the PPE in relation to this working. So we said this 560 will be added to the group PPE, and then this depreciation other charge of 70 will be deducted from the PPE. 2 adjustments here. 2 adjustments, we add the revaluation gain of 560, we less the depreciation other charge of 70. We get the final value there. The final value will be what? What will be the final value? The final value, I'm told by Gilbert, will be 8380. 8380. That is the same figure I'm getting from Diana. So then from there, below that, we have investment in paper, investment in CSAS. Remember, these are the purchase considerations which were paid by the parent company in acquiring shares of CSAS and paper. Do you include that here? No. In relation to the subsidiary, which is paper, what we include here is the goodwill. We include the goodwill on acquisition of the subsidiary, which is paper limited. And basically that's what we computed here, 320. 320. In relation to CSAS, which is the joint venture, we compute something called the investment. The investment in joint venture, or basically joint arrangement. I just refer to it as the joint what? The joint arrangement. And basically we recognize that here is an item of what? As an item of non-current asset. I want us to have the working here, because I remember I've given you the format for computing this. How do we compute the investment in associate or joint venture? I said one, you take the purchase consideration which was paid, or the cost of investment. That is basically what we have within the statement of financial, or within the statement of financial position of the parent under the non-current asset. How much purchase consideration was paid by the parent company in acquiring the shares of the joint venture? That is 15. That is 15. And then to this we have said we add what? To this we have said we add the group share of the joint venture post-acquisition retained earnings. And basically take into account our joint venture was acquired during the current year, CSAS was acquired during the current year. The amount which we include here, which we have included here, that is now the same with the group share of the post-acquisition retained earnings of the associate. That is basically what we will add here, 160, this one. And then to this we less any impairment loss. And I hope you can be able to recall in note number 4, we were told that in note number 4, we are told the goodwill on acquisition, the investment in associate had not impaired. They were unimpaired. So we don't have any impairment loss. And that will give us what? 1660. That will give us 1660. So that basically what we include there. Then from there we proceed and basically we record the current assets. So for the current asset, we are given the total. We will take that is 720. That is of the parent plus that of the subsidiary, 2270. And then in this case, you have to recall that inventory, receivables, cash, and bank balance are part of this. Any adjustment affecting this inventory and receivables should be made here. And I think you can be able to recall here, we have this and this profit, which we say should be deducted from the group inventory. Inventory is part of this. So we less unrealized profit of 50. And also we have the amount of intercompany debt, this one, of 500. We also less it here. I don't think we have any other adjustment. So let's get the final figure. We get the final figure. I don't think we have any other adjustments. So what is the final figure here? I'm given 50, 440, 5440, 5440. Yes. So then what will be our total? What will be our total assets? What will be our total assets? You add all this, you give me the total assets. And because of space, I want to do away with this one. I want to do away with this one. Yes, the total asset in our case will be 15,800. I want to do away with this now. Yes. So then from this, we need to move. And basically, we record equity. So for the equity, we will start with the ordinary share capital. Ordinary share capital. And I hope you can be able to recall the ordinary share capital. We don't consolidate this. We only include the ordinary share capital, that of the parent company only. The ordinary share capital of the parent company only, which is how much? Which is 5,000. 5,000. Below that, what do we have? We have share premium. Equally, the share premium, we basically include that of the parent company only. That of the parent company only, which is 500. So below that, we have what? We have the retained earnings. So basically, retained earnings is one of the item which is a little bit tricky in terms of its computation. Maybe first of all, we can skip this one. We will come back and compute it. Then we will get what? We will get the total equity. We will get the total equity. And I hope you can also be able to recall your total in a fund. These are some of the items you don't have to compute in an exam. They will consume a lot of your time and you end up maybe getting that figure wrong. So, but we will come back and compute. We will compute that. Then down here, after getting this, we also come and we compute something called the non-controlling interest. I'll be able to explain what is this in the process of computing that, but we will compute this as the last two items. Then from there, we need to proceed and we record liabilities. I think for liabilities, we have the current liabilities, but in this case, there is something we are going to introduce. We are going to introduce non-current liabilities. I hope you can be able to remember this deferred consideration. These are consideration to be paid by the parent company in future. So that deferred consideration will be recognized here as a non-current liability. And basically, I've said the value for deferred consideration at the end of the day is this one. We have amortized that. So this amount plus the interest for that year, which will give us what? Which will give us 2110. And then finally we have the current liabilities. Current liabilities, we take those of the parent 3,000 plus 19, those of the subsidiary. And then you have now to recall that these include payables. Payables, we have amount of intercompany debt, which should be adjusted from the payables, this one, 500. So that one should be deducted here, 500. So give me the final figure. Give me the final figure here. The final figure for payables, for current liabilities. For current liabilities, I'm told is what? 44. Yes, 44. 44. So what I want us to do, I want us to compute these two items here very fast. Very, very fast. We should be able to do that in the next 10 minutes. We should be done. Yes, so we can start by computing what? Let's start by computing the group retained earnings. But basically, I've said, if, for example, you're doing that question in an exam, and basically you leave it like that, you should be able to get all marks. You should be able to get all the marks. So let's start by computing this one. The group retained earnings at the end of the year, that is carried down. That is carried down. That is carried down. So how do we compute this one? How do we compute this? So the first thing maybe you need to remember is the formula. How do we compute this? So this one is computed by taking the 100% of the parent company retained earnings plus for this company here, that is paper, we should take 80% of a post-acquisition retained account here. I want us to look on the format, and then I will be able to explain how we compute a number of items. So this particular account is basically prepared using a vertical format, not the T format. So the revenue account. So assuming our insurance company, basically at the take to insurance business, maybe like the fire insurance or the provide to insurance business, the fire insurance, and maybe the life insurance. So basically in that case, we have two columns here. And when preparing this, always we start with the incomes, or basically the revenue from each insurance business, the revenue from each insurance business. So the first, or basically what we know is that once you have insured a certain subject matter, you have to pay something called a premium to your insurance company. So this premium is one main source of income as far as these insurance businesses are concerned, the net premium. But in this case, we're going to look on how do we compute this. Maybe we will have working one. Basically, we look on how do we compute the net premium, because that is something which the examiner will not have given you. You have to compute that. And then out to this, and basically what we know is that if, for example, you have insured a certain subject matter, you pay the premium in advance. For example, you own a car, you have insured your car, you pay the premium in advance. Some insurance companies may tell you, can you pay this in 2 installments? So, but you pay the premium in advance. So therefore, we know that that premium which you are paying basically covers or basically is the insurance cover for the next 1 year. For the next 1 year. So basically, much of the money collected by the insurance company or much of the revenue is received in advance. Now, this premium is only supposed to be recognized as an income by the insurance company once the period covered has expired. For example, if the insurance company has received premium of 1 billion, it covers the next 2 years. So that premium will only be deemed to have to be earned as an income once the 2 years are over, or basically 1 year is over. So therefore, you may see that out of these particular premiums which were received during the current year, you may be told that part of it was not yet earned because the period covered has not done what? Yes, I hope now it is clear. Yes, so basically what I'm saying here is that this is basically a contract which is entered into between two parties, the insurance company or basically the insurer, and basically another person who is called the insured. And in this contract, the insurance company basically undertakes to compensate the insured on the happening of a contingency, or basically on the happening of a future uncertain event. And now the insured on his part basically commit himself to be paying some periodical payments, which are known as what? The premiums, which are known as what? The premiums. So therefore, it's a contract between two parties, the insurance company or the insurer, and the insurance company undertakes to compensate the insured on the happening of a future uncertain event. And this person on his part must be paying some periodical payments, which are known as what? The premiums. Now, these insurance companies usually provide various types of insurance businesses, and those insurance businesses are usually classified into two. So mean that we have two types of insurance business. Majorly we have two, or they are classified into two. We have direct insurance. And when we talk about direct insurance, this is a type of an insurance contract whereby the insurance company basically undertakes to compensate, or basically to pay the insured a certain amount of money, which is known as a lump sum, upon the insured attaining a certain age, or basically upon his death, whichever occurs earlier. So in this case now, a lump sum will have to be paid to the insured either upon attaining a certain age, or basically upon his death, whichever will occur earlier. Then from there we have now the general insurance. So when we talk about the general insurance, this refers to any other insurance business other than the life insurance, insurance or the life assurance. And therefore, the general insurance, this includes insurance businesses such as burglary insurance. You have a business, you insure your business against theft. We have the fire insurance, we have the motor vehicle insurance, we have the marine insurance, and so on. So all those types of insurance business, they fall under what you call the general what? The general insurance. So now the insurance companies, or basically those particular companies which undertake insurance business, at the end of each year, they are expected to prepare financial statement. And the financial statement prepared by these insurance companies include: number one, we have the revenue account. Number two, we have the general statement of a profit or loss, or basically the income statement. And number three, we have the statement of financial position. So let's start by looking on what we mean by the revenue account. The revenue account. Now, the revenue account, basically, this is an account which is prepared to determine the performance of each insurance business. An audit client has been trading for several years. He has provided you with the following list of account balances as at 31st of December 2022. So basically, these are a list of balances. Remember, in this case, you are an auditor, or basically you are auditing this particular company here, and you're given these particular balances. We have the capital, we have the revenue, the trade payables, the return outward, expected credit losses. Remember, in this case, I said when talk about the expected credit losses, these are the expected doubting here. Yes, so this, I think, is a question which was examined in the sitting of April of 2024, if I'm not very wrong. So this is a question from the sitting of April 2024. What are we told? We are told Mr. 𝐅𝐎𝐂𝐒, an audit client, has been trading for several years. He has provided you with the following list of account balances as at 31st of December 2022. So basically, these are a list of balances. Remember, in this case, you are an auditor, or basically you are auditing this particular company here, and you're given these particular balances. We have the capital, we have the revenue, the trade payables, the return outward, expected credit losses. Remember, in this case, I said when talk about the expected credit losses, these are the expected doubtful debt. Now, currently, I said the one which is used is expected credit losses. Nowadays, we don't talk of the doubtful debt, but we talk of the expected credit losses. And basically, what we have here, this is what previously we used to refer to as the allowance or the provision for doubtful debt. This is now what is known as the expected credit losses at the start. Below that, we have the discount allowed, discount received purchases, return inwards, distribution cost, drawings, rent rate and insurance, heating and writing, postage, stationery and telephone, advertising, salaries and wages, credit losses. Remember, even the question we did yesterday, there is a question we did for taxation. We came across this word here, credit losses. Credit losses, I said, these currently, or basically this previously what we used to refer to as the bad debt written off. Do we still talk of bad debt written off? No, we talk of the credit losses. So credit losses is equivalent to the bad debts which were written off. We have cash in hand, cash at bank. We have inventory at the stand. We have trade receivables, property, equipment, and furniture at cost, accumulated depreciation. And okay, so what is this now? What is this? Basically, I'll be able to confirm what is this. Okay, so I hope I'll be able to get the original question because I need to confirm what is that. So then we have the depreciation. The depreciation, maybe if you are in a position to access the original paper, if you are in a position to access the original paper, so I'll be able to confirm this. Maybe you can tell us what is this? What is this? What this D is? Because basically we need to know what is that. So if you're in a position to access the original papers, please maybe you can tell us. You can tell us what is this? What is this? So let me see whether I can be able to get those papers in my phone. Yes, so let me confirm. Okay. Okay, let me see. Okay, so I'm told by Judy, this is accumulated depreciation. Yes, okay, thank you, Judy. Yes, I think also I've seen, have I seen, yes, I think I've seen this. Yes, so this basically the accumulated depreciation at the end of the year. Is that the position? Yes, let me change this to accumulated depreciation on 31st of December 2020 when the year ended 2022. 2022. I hope that is then correct. I hope that is correct. Yes. So I'm told this question is for April 2023, not April 2024. This is April 2023. April 2023. I also need to change this one. Should be April 2023. Thank you for that. Okay, so we have that accumulated depreciation. So another item has disappeared here. Oops. Let me just a minute. Which expense was this one? This was which expense? Which expense was this? Below heating and lighting. I think equally you can be able to counter check. I don't know whether the original paper which I shared, it has those details in the class WhatsApp group. Which expense is this one? Or which item do we have below heating and lighting? Below heating and lighting, what do we have? Someone to confirm for me. Judith, which is below, okay, Sawa. Yes, I think we have interfered with our original document here. Let me. Yes, so that should be postage, stationery, and telephone. That is basically an expense. Okay, so then we are given basically those particular balances, and then you're told as you begin the audit process, you discover the foreign adjustment that should be made to finalize the financial statement as you carry out the substantive test. I hope you can be able to remember what are substantive tests. Substantive tests, these are basically detailed audit tests to be undertaken in the books of account, including the account balances. So we're given some adjustments. So we are given the closing inventory. We have insurance, which was prepaid. We have heating and rating accrued. We have prepaid rates. We have end-year credit losses, or the end-year expected credit losses is estimated at 1,865,000. Remember, this now like the provision or allowance for doubtful debt at the end of the year. I hope you can be able to recall how we used to account for this in financial accounting. So then we also given errors through commissions. So we are told an invoice for goods sold was not posted. So, and basically what this requires, for you to be able to answer this question comfortably, you must be very much okay with financial accounting, because this is all about financial accounting. For example, in this case, once we are told an invoice for goods sold was not posted. So how should we account for this? This is quite simple, because once you sell goods on credit, you issue an invoice. So that invoice which you have issued, what is the double entry for that? Automatically we debit the receivables, we credit the revenue, or we credit the sales account. You can see that here the issue is double entry. Number two, drawings of goods not reflected in the drawings. So drawings of goods, how do we account for that? We debit the drawings account, we credit purchases. Number three, an additional credit loss omitted. These are additional bad debts which were written off. So how do we account for this? This one will be debited, will be added to the credit losses already written off, and deducted from the receivables. We are also given the depreciation expense for the year is understated with 120,000. So what are we required to do here? We are required to prepare an audit schedule for 8 columns with the following headings. 1, the original trial balance without adjustment. Roman 2, adjustments. Roman 3, the draft profit or loss item. Roman 4, the draft statement of financial position. Each section should have the debit and the credit column, and which is duly balanced. You can see this question is similar to the other one which we did, but you can see this question is having now some additional what? Some additional items. So what we basically we need to do here is we split our worksheet into two, or Excel worksheet into two. So basically, this will be our solution. So this is an 8 column. This is an 8 column worksheet. And basically this 8 column worksheet, we are required, or we are given the sections to be included. Included here. So automatically we are going to start with the details column. We will start with the details column. Then from there, we can have the original trial balance, because I hope you can remember we are given the sections to be included here. The first one should be the original trial balance. Maybe I can just copy this one. The original trial balance. Let me just copy this one. Original trial balance. Maybe I can have that from here. That is the original trial balance. So, and then in this case, in the original trial balance, remember, we need to have 2 columns in each section, the debit and the credit column. Then we will have the other section, which is basically the adjustment column. And in this case, we will equally have the debit and the credit column like that. And then from there, we will have the statement of profit or loss. Statement of profit or loss. And then finally, remember also here we need to have 2 columns, the debit and credit. And finally, we will have the statement of financial position, which was formerly known as the balance sheet. Equally here, we need to have two columns like that, two columns like that. And then I hope you can also see the figures we're given here are in thousands of shillings. So we equally up there, we need to indicate all our figures will be in thousands of shillings. So I need to copy this one. I'll copy that and basically paste that across. So paste, control V, yes, like that. Then I think I need to split this. This will be our original trial balance. The adjustment section, our statement of profit or loss, our statement of profit or loss, and finally, we have the statement of financial position, statement of financial position like that. So maybe we can make this one a little bit, we can expand this. Yes, so I think now we can move and basically we start by preparing the original trial balance. So how do we prepare the original trial balance? We prepare the original trial balance basically from the balances which we have here. From these balances which we have here, these are the balances we use to prepare the original trial balance. So what we need to do, first of all, I will pick these particular balances, or I pick these particular items, not balances, all these items, all of them, I'll copy them. I copy them and then I transfer them here. Basically from here, I paste them here, Control V. Okay. Let me copy them afresh. Control C. And then I need to paste them here, Control V, like that. Yes, Control V. Now, basically what I need to do is to bring these particular items, or actually, you can see these balances which are given here. They are not arranged within our trial balance. But I think I said that once you're given a number of balances, you need to know each item, each of these balances will go to which side of the original trial balance. Will it go to the debit or the credit side of what? Of the trial balance. And I think there is something I gave you yesterday. There is a certain acronym I gave you yesterday, and the acronym is what? Is DIDA. The acronym is DIDA, D for drawings, that is capital D for drawings, and then E for expenses, A for assets. We said all these items in the trial balance, they have a debit balance. That is the first thing you need to remember. And I hope you can be able to hear me. I think my mic have gone off. Let me just confirm here. Yes, so can you confirm whether you can hear me, whether Morimo is audible? My mics have gone off. Am I clear? Am I audible from your side? I hope my sound may not be that clear, but you should be able to hear me. Okay. So let's basically continue here. Let's continue. Yeah. So I said that these three items, that is drawings, expenses, and assets, all these items, they have a debit balance within the trial balance. That's the first thing you need to remember. They have a debit balance within what? The trial balance. And then we have the other three items, that is L, which stand for liabilities. And then we have
E, which stands for equity, that is share capital and reserves. And then we have R, which stands for revenue, or basically incomes. We see that all these particular items here, they have a credit balance within what? The trial balance. They have a credit balance within what? The trial balance. So if you're able to remember this, then you should be able to prepare the original trial balance. The original what? Trial balance. The original trial balance. That basically the first thing we need to do. Let's therefore, first of all, we come up with the original trial balance. So, and actually, we're going to use these particular items here. And I think, first of all, you can do away with these particular zeros. We can remove these decimal places. We just need to come here and we reduce. We do away with those decimals like that. Yes. Now, we start with the first item of capital. This item of capital, it has a credit balance. So, this one will go to the trial balance on the credit side. On the credit side like that. Revenue will also go to the credit side because this is an item of income. So below that we have payables, is a liability. It will go to the credit side. Below that we have expected credit losses. Expected credit losses, this is a provision. This money which is set aside to cater for those particular debts which will not be paid in the future. So these are provision. Anytime you're given a provision for depreciation, the provision for expected losses, all provisions, they have a credit balance. So this will go to the credit side. Okay, before we do that, let's post this one, but there is an item we have skipped. So all items, all provisions, they have a credit balance, but there is an item which I've skipped here. That is the return outwards. Now, first of all, which is the other name for return outwards? Return outwards has another name. Who can remind us the other name for return outwards? Return outwards. Return outwards. Return outwards. Who can be able to remind us the other name for this? Return outwards. Let me see. Let me see whether you can be able to remember what you did in financial accounting. Return outwards. Return outwards. Return outwards, I'm told by 𝐿𝐍 sales return. Is that the position? 𝐿𝐍? No. That is not the position. That is not the position. That is not the position. Return outwards is basically what you have purchased, but you return it out, or you return it back to your suppliers. So the return outwards, basically this is the other name for purchases return. This is the other name for purchases return. It's very, very important for you to remember that. This is another name for the purchases return. The purchases return. Now, the purchases return, basically, this one reduces the purchases. And remember purchases, this one is basically an expense. All purchases, or basically purchases in the trial balance, this one should be recorded in the debit column because it's an expense. And therefore, these purchases return because they reduces the purchases. This one should also go to the trial balance on the credit side because this one reduces the purchases. In the trial balance on the credit side. I think we have dealt with the expected credit losses. Discount allowed, this one is an expense. Once you allow discount in your business is an expense, it will go to the debit side of the trial balance. Discount received is an income. It will go to the credit side of the trial balance. The discount received, this one is an income. Then from there we have purchases. This is an expense. It goes to the debit side of the trial balance. Below that we have return inwards. The return inwards, this now is what in other terms we refer to as the sales return. The sales what? The sales returns. The sales return. The sales return. Now the sales, basically that one go to the trial balance on the credit side, the sales. And the sales return or the return inwards, because it reduces the sales, this one should go to the debit, to the trial balance on the debit side. On the debit side, because this one should reduce our sales. Distribution cost is an expense. It will go to the debit side. Drawings, this one as per the acronym DIRA, this one go to the debit side. So then we have the rent insurance. Rent rate insurance is an expense, go to the debit side. We have Heating and lighting is an expense, go to the debit side. Postage, stationary, telephone is an expense, go to the debit side. Advertising is an expense, will go to the debit side of the trial balance. So below that, we have the salaries and wages, go to the trial balance on the debit side. We have the credit losses, the budget written off is an expense, go to the debit side. Cash in hand is an asset, will go to the debit side. Cash at bank is an asset, still go to the debit side. The inventory at the stand is an asset, will go to the debit side. The receivables is an asset, will go to the debit side. Property, equipment, and furniture is an asset, will go to the debit side. How much is that? Is that amount? And then we have accumulated depreciation at the end. Accumulated depreciation at the end is like a provision for depreciation. If provision has a credit balance, this will go to the credit side. Then in this case, we are given the depreciation for the current year. The depreciation for the current year has already been computed, is an expense, go to the trial balance on the credit side. So those are the balances which were extracted from the trial balance. And if everything is given here, this original trial balance should balance. This original trial balance should do what? Should balance. So let's do that. We get the totals here, down there. We see whether it will balance. The trial balance balancing? Yes. You can see our trial balance is what? Is balancing there. Our trial balance is balancing. Our trial balance is balancing. That is basically the original trial balance. It is balancing at the amount of 221, 143, 143. So that is the first segment, or the first part of that question. We prepare the original what? The original trial balance. The original what? The original trial balance. Now, after preparing that original trial balance, then we are required to make the adjustment. And I hope you're together up to that point. Is there any question up to that point regarding what you have done? Any question up to that point? Any question up to that point? Okay, none. So let's move and we make now the adjustments. We make the adjustment. Remember, we said that the adjustment basically refers to the AD adjustment. Now, these are the balances which were extracted in the trial balance, but basically we said at the end of the year when preparing the financial statement, you need to make a number of adjustments. You need to adjust some of these particular what? Balances with things like the prepaid expenses, the accrued expenses, and maybe an error which was made. So in our case, we are told here, as you begin the audit, you discover the following adjustments that should be made to finalize the financial statement as you carry out the substantive test. So we are given a number of items. So we will start with the first one, which is basically the closing inventory. I will copy that and I will have it here. Remember, these are the adjustments. I will just I can note that these are the adjustments. These are the adjustments. So the first item is the closing inventory. The closing inventory is the closing inventory. Now, the closing inventory, if you can be able to recall what we said yesterday, this one will not affect any of the item within our original trial balance. So none of the item within the original trial balance will basically be affected by this what? Will be affected by this closing inventory. So therefore, what we said, this closing inventory, we will take it directly to the income statement and also the statement of what? The statement of financial position. We take it directly to the income statement and what? And the statement of profit or loss and the statement of financial position. And I hope you can be able to recall the format or basically the formula with which we're able to discuss. I think we can just have it here again. So remember, you said that when preparing the statement of profit or loss, we prepare it to compute the profit or basically the loss for the year. the profit or the loss forward for the year. How do we compute the profit or loss for the year? We take the sales, in other terms, which, what is known as the revenue. We minus the cost of sales, the cost of what? Sales. But basically, in our case, how do we compute this cost of sales? We can come up with a formula. Compute the cost of sales. We take the opening inventory. To this, we add purchases. And because in this question we have purchases return, we will also incorporate that within our equation. But if you can remember the other question we did, because we didn't have purchases return, we never captured that in our equation. So the purchases return, P and that should be deducted from the purchases. That one should be deducted from purchases, and then to this we less the closing inventory. That is how we compute the cost of sales, and then we get the gross profit. This gross profit, we said we add other incomes. We add other incomes, we get the total incomes, and finally less the expenses. We less the expenses like that. And I hope you can also be able to remember in this question here, we have sales return. We have sales return. When we deduct the sales return, the sales return, this one should be deducted from our sales figure. So to this, we will less the sales return, or in other terms, the return what? Inwards. Return inwards. So I want us, we come up with a final figure for computing the profit or loss. So the profit or loss will be equal to the sales. Sales, I can just use S for sales minus return inwards, and then I need to open this bracket and multiply everything here with the -1. So we will have minus opening inventory minus purchases. Once we multiply a negative and a positive, it will become negative, minus purchases, and then minus 1 times purchases return, which will become plus purchases return, and then this minus times minus, it will become positive, closing inventory. So we are done, and then to this, then we will take the other incomes, and then to that finally we less what? We less the expenses. So this is basically the formula now which you need to have for you to be able to prepare the statement of profit or loss, because we said all the items here which are basically positive, those items which are positive within our equation here, those items which are positive, we record them on which side? Okay, that is one is reflected as recognized as a function. So those items which are positive, we take them to the statement of profit or loss on the credit side. That's basically what we said. Those items which are negative, we record them in our statement of profit or loss on which side? On the debit side. On the debit what? Side. That's basically what you need to know. So therefore, the closing inventory, remember, we have said that will not be adjusted within or will not affect any of the item in the original what? Trial balance. So therefore, this one, number one, we will take it to the statement of financial position. The last part of this 8-column worksheet. So, and basically that one we take it to the last column here is an asset. So being an asset, we record it on the debit column, because also I hope you can be able to remember when preparing this statement of financial position, what do we record on the debit side? On the debit column, that is. On the debit column here, we said we record assets. We record assets. That is what we record on the debit column, and then on the credit column we record equity and liabilities. That basically what we said. So that is what you need to remember. Yes. So let's record this closing inventory here. First of all, as an asset, it is that amount. Then number two, where do we record it in our statement of profit or loss? As per this equation, you can see closing inventory is a positive. Being a positive, it will go to the credit side. It will go to the credit side of the statement of profit or loss here. It will go to the credit side there. So we are basically done with that item. So the other one is prepaid insurance. Let me just copy this one. I copy this prepaid insurance. I bring it here. I paste it. So the prepaid insurance, this will go to the adjustment column, because I hope we can remember in this particular original trial balance, we have such an expense. We have such an expense, that is insurance. Where do we have insurance here? The insurance is part of this. And because we have a prepaid insurance, it basically means that included in this figure is an amount which was paid during the current year, but it related to the following financial year. So therefore, number one, we are going to deduct that amount from here. So to reduce this one, we will come to this adjustment column. This adjustment column, and basically we do what? We do what? We credit. So in this row here, we will credit the rent, rate, and insurance with that particular amount. How much is the amount? So we take that amount directly up there, 560. So you can see we have credited the rent, rate, and insurance basically to reduce that. And then we said we must complete the double entry. So meaning that here we also need to debit. We need to debit the adjustment. The adjustment what? The adjustment section. The adjustment what? Section. The adjustment section. Yes. So the adjustment section, is that what you have done? It should be here. Should be here. Okay. So let me take this particular amount here. Yes. So then from there we have heating, writing, which were accrued. So these are the expenses which were not yet paid. So this one, we need to add it to this amount here, because out of this, there was an amount which was not yet paid. So we add it by debiting this account. So how much is the amount? Is 680. Then from there, because we have debited this, the adjustment column we credit. We credit an equivalent amount. We credit an equivalent amount of 680. So then from there we have the prepaid rates. Prepaid rates. So let's copy this prepaid rates. So prepaid rates, basically these are rates which were paid in advance. So, and I think rates are part of this one. So we need to reduce this. So I think what we will need to do here, because you can see there was another amount which was prepaid, I think we will record the total here. We record the total. So the total here should be 560. This one 560. Where do we have that? 560 plus. No, this one. Let me do away with that formula. Or I need to remove this figure. Yes, I will take this one 560, and then I will add. Okay, I will add this one, the prepaid rates, and basically I'll get the total. So the total prepaid insurance and rates is basically the amount of 32,77,500. So basically what I've done, I've credited that account with the total amount with this prepaid insurance and the prepaid rates. And then for the prepaid rates, because we have credited that account, we need to debit it here. So this one will be debited here, so that we complete the double entry. We complete the double entry. Then from there we have the expected credit losses at the end of the year. I've said the expected credit losses at the end of the year This is the same with the provision for doubtful debts at the end of the year, because this previously what we used to refer to as the provision or the allowance for doubtful debts at the end of what? Of the year. Now, how much amount is that? It is 1865,000. Now, remember, basically what we do is that for this particular amount, or if you can be able to recall what you used to do in financial accounting, you used to compare the allowance for doubtful debts at the start and the allowance for doubtful debts at the end of what? Of the year. And basically the increase or the decrease was the one which was taken to the income statement. A decrease was recognized as an income, and then that is, a decrease was recognized as an income, but an increase was recognized as what? As an expense. So what we need to do is basically compare this with the allowance or with the expected credit losses at the start. The expected credit losses was this at the start. What about at the end of the year? At the end of the year, it has increased. It has increased. So basically what we need to do is we are going to increase this one with the difference. So this one, we are going to increase it to that amount which we have. So what is the difference? Maybe I can just compute it here. I will take this one, the expected credit losses at the end minus the one at the start. This one. So that is increasing with this 608. Now we are going to increase that with 609, not 608. And basically this amount then, we also put it here. We also put it here so that we complete the double entry. And basically, I think specifically we can refer to this, or what you have accounted for here is the increase. Is the increase in the expected losses. The increase in expected losses. The increase in expected losses. The increase in expected losses. Okay. So I'm saying, someone is saying, pardon. So I'm saying that this particular expected credit losses, this previously what we used to refer to as what? The provision for doubtful debts. The provision for doubtful what? Debt. So basically what we do as far as the provision or allowance for doubtful debts is concerned, what we account for during the current year is the increase or the decrease. The increase or the decrease. So and in our case, we are saying this amount increased with 609. So if it is an increase, we are saying we should increase this. Yes, I can see I've made a mistake because increasing this, yes, to increase is correct because you can see this account is credited. So if we want to increase this, we credit that with the increase. So if we credit this with the increase 609, we will increase that now to the amount which we have here. The amount which we have here. That is 1865,000. 1865,000. 1865,000. I hope that is the same accounting treatment we made for the other question we did yesterday. Is that what we did? Yeah, for the other question we did yesterday. We made the same adjustment. Do we make the same adjustment? But I think in our case, we were not given the allowance for debt or the expected credit losses at the start. Are we given at the start? No. So we were not given at the start. That's why you can see in this one, there is a slight difference because we have at the start, at the end. So what we account for during the current year is the increase. We will increase this with 609 and then we debit this. I hope that is now clear. Is it clear? So that we move to the other item. Is it clear? Is it clear? Is it clear? Okay, so let's move to the other item. And I think we are done with this particular AD adjustment. So then we are given some omissions or basically errors. So in this case, we just need to know how were these errors supposed to be corrected. How do we correct these particular errors? So the first error, we are told an invoice for goods sold was not posted. This is basically an error. So this is an error. An invoice for goods sold was not what? Posted, was not posted. So a company sell goods, that is basically sales. And number two, this one should increase the receivables. This one should increase what? The receivables. So let's have that here. We have that here. Yes, an invoice for goods sold was not what? Posted, was not posted. Now, remember what we need to do this one. We need to effect a double entry. A double entry. A double entry for this will affect what? Will affect sales, will affect receivables. Sales and receivables. So take into account it will affect sales and receivables. Number one, we need to increase this. How do we increase sales? We increase sales by crediting sales. We will credit sales. So the sales account with an amount of how much? With an amount of this one. That one, we enter that. And then we do what? We debit receivables. We debit the receivables. Where do we have the receivables? We have the receivable somewhere here. We have the receivable somewhere here. Where do we have the receivables? The receivables are here. So we debit this. We debit this. We debit this. We debit this. We debit that. And in fact, I don't think we need to record the details here, because you can see by the end of the day, that will not be recorded in the adjustment column. It will not be recorded in what? The statement of profit or loss, or what? The statement of financial position. But let's just record it here. But basically that one will not be recorded anywhere here, because we just need to effect a double entry. We increase our sales, we also increase our receivables with that particular amount. Yes. So then from there we have the other error which was basically made. So we are told drawings of goods not reflected in the drawings. Drawings not yet accounted for. So who can tell us what will be the double entry for this? See whether you are understanding what Marino is doing here. What is the double entry for drawings? Drawings not yet accounted for. Drawings, which account do we debit, which account do we credit? Because remember, these are errors. That is basically what we are correcting. Which account do we debit, which account do we credit? Which account do we debit, which account do we credit? Drawings not yet accounted for. 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 Yes, let me see what I'm told here. So we debit the drawings, we credit receivables. No. Is that the correct accounting entry? No. Can I get more trials? Remember this financial accounting. Whatever you did in financial accounting, this is basically what is being tested here. Whatever you did in financial accounting. So I'm told we debit purchases. Is that the position? No, the drawings, basically once you make the drawings, this one increases the purchases, and then you are making drawings for goods. That one will also reduce the purchases. So the drawings not yet reflected one, these will increase the drawings. These will increase the drawings. Where do we have the drawings? The drawings, we have them here. So we need to increase this. To increase this, we debit drawings. We debit drawings. We debit drawings with an amount of 450,000. And then we credit purchases. Where do we have purchases? We have purchases up here. We have purchases up here. We credit purchases. Reduce purchases here with an amount of 450. With an amount of 450. So equally here, that one will not go to the adjustment. It will equally not go to the will this go to the statement of no, because we will deduct that directly from the purchases, so that we get the net purchases. That basically what we are going to take to the statement of profit or loss, the net purchases. Okay. So then we are told additional credit losses which were omitted. These are additional budgets which were written off. So need to have that here. So the additional credit losses. So these are additional budgets which were written off. Now, what basically we need to do in addition to this error, one, we are going to increase the credit losses which were written off, or the budgets which were written off, and number two, we reduce our receivables, because once we write off some budgets, we debit the credit losses, which is in other terms as a budget written off account. We increase the credit losses and we credit the receivables. We credit the receivables. So when we have the credit losses, we have them here. This one is the expected, but we need to have the credit losses, this one. So we need to increase this. So to increase this, we debit. To increase this one, we debit. We debit that account, and then we credit the receivables. Where do we have the receivables? The receivables, we have them here. We credit here. Yes, like that. So we are done with that, and then we are told finally. So, and remember, you say that as far as the preparation of this 8-column worksheet is concerned, you just need to know how to deal with those particular adjustments, because once we are dealt with those adjustments, extracting the statement of profit or loss, extracting statement of financial position, that one is quite simple. So we copy this one and we basically bring it here. We copy. Copy this one, we have it here. Okay. Let me copy that afresh. We Control C, we Control V here. So this basically depreciation expense for the year which is understated. So depreciation for the current year which is understated basically means, I hope you can remember we already given the depreciation for the current year. This one is understated. So we need to increase it. So once a depreciation or an expense is understated, you need to correct that by increasing it, and that is an amount of 120. We increase that depreciation for the current year by basically debiting this, and then number two, this one will increase the accumulated depreciation at the end. This one will increase. So to increase this, we credit this account with 120. Credit that with one what? With 120. And I think we are done with those adjustments. So we are done with those adjustments. So what do we need to do now? What we need to do basically is remember these items will not go to the statement of profit or loss, to the adjustments, and so on. Yes, so I think we basically need to get the totals here in the adjustment column or the adjustment section, and automatically this one should automatically do what? Balance. That basically what we know. This one should also automatically balance. Whatever you have on the debit and whatever you have on the credit should be the same. Mukari is asking about depreciation. Depreciation, we have said, remember, in our case, we are told the depreciation was understated. Which depreciation was understated? It is this depreciation expense for the current year. So if this one is understated, depreciation is an expense. If it's understated, you want to increase it. So we debit this account. We debit, we record it here in the adjustment section of the debit. Then number two, this one also increases the accumulated depreciation at the start, because how do we account for depreciation for the current year? We debit the depreciation account, we credit the accumulated depreciation account. So we increase this, we increase that. Yes. So those are the two items to be adjusted. And basically, I'm saying now, once we get the totals down there, you can see they are the same. They are the same. They are the same. They are the same. So having done that now, our question becomes very, very simple. So we just need now to finalize by doing what? By preparing the statement of profit or loss, the statement of financial position. Just finalizing now. Just finalizing. Just what? Finalizing. So we start by preparing the statement of profit or loss. Actually, we can prepare these last two sections concurrently. The statement of financial position and the statement of a profit or loss. So because this is just what you need to remember. Statement of a profit or loss. So this is basically what you need to remember here. Then in the preparation of the statement of financial position, here you just need to remember that assets, this one will be recorded on the debit side. And then the capital and liabilities will be on the credit side, on the credit column. Capital and liabilities will be on the credit column. I think if you can be able to remember that, then this one becomes quite simple. Quite simple. So let's just finalize this one. Let's just finalize this one. So we go back to what we have here. The first item we have is capital. Capital, this one go to the statement of financial position, basically on the credit side. Is it to be adjusted? No. Revenue, basically this is an income. It will go to the statement of profit or loss and on the credit side. But I hope you can remember, you see there is an adjustment. So we will take this as this amount here, which is to be credited. Credit revenue is to add, to increase the revenue. So payables is a liability. This one go to the statement of financial position. Is it having any adjustment? No. Below that, we have the purchases return or the return inwards. We need to go back down here and we see when we record purchases return or the return inwards. Purchases return is basically what is denoted by PR. PR you can see is a positive. Being a positive, we have said all items which are positive, they go to the debit side. All items which are negative go to the credit side. So purchases go to the statement of profit or loss, and because it's a positive, it go to the credit side. It go to the credit side of the statement of profit or loss. Below that, we have expected credit losses. Expected credit losses, this one, number one, we take this to the income statement. The increase, we take it to the income statement. I don't know whether we recorded that down here. Let me see. Expected credit losses. Yes, I think we can do this. Expected credit losses. Let's bring this figure here. This one, we bring it here. What we're going to do for this one, we will compute the total expected losses at the end of the year, and then we less that from the receivables. Yes, so let's record this amount here. When we have it, this one, the increase, because remember this is the increase. This one we are going to recognize it as an expense. In the statement of profit or loss. The increase in expected credit losses is an expense. Then from there, this one, I'll basically use this one in computing the receivables figure at the end of the year. The receivables figure. But I think the receivables figure will also be having another adjustment. Yes. So maybe first of all, we can skip that one. But basically, remember this one is not an expense, is not an asset or liability, but this one is always be adjusted in the receivables figure. So we are going to adjust that in the receivables figure. So then the discount is an expense. Discount allowed is an expense. Discount received is an okay. This one is an expense. Go to the debit side. Discount received is an income. It will go to the credit side of the statement of profit or loss. So below that we have purchases. Purchases is an expense. Statement of profit or loss on the debit side. But I hope you can see we have an adjustment here. Purchases is to be reduced. Is that the position? Yes. So that's why you can see we are crediting. So to credit purchases is to reduce. So we take this minus this. That would be the net purchases. Where do we record the sales return? As per our formula down here, the sales return. Sales return is a negative. So being a negative, it will go to the debit side. That's what you basically say. It will go to the debit side of the statement of profit or loss. Go to the debit side. Debit side here. Yes. So below that we have distribution cost is an expense. Go to the debit side. Below that we have drawings. Drawings. Where do we check drawings? Drawings, basically this one is not is what? Is not an expense. Drawings basically is supposed to be deducted from capital. I hope you can be able to remember that. We less drawings from the capital. Is that the position? Yes. Drawings, basically this one we less it from what? The capital. So therefore, what we will do just like what you have said in relation to this, in relation to this expected credit losses or the allowance or the provision for doubtful debt, this one will not go here to the statement of profit or loss or the statement of financial position. This one will be adjusted in the receivables figure. The same case with this one. The same case with these drawings. These drawings, basically we are going to, this one will be adjusted in the capital. So therefore, I think what we need to do this capital figure, figure for capital, this one need to be adjusted. And actually we are going to adjust that with also the profit. So this figure, basically we are going to adjust it. Maybe I can just put it in red so that we remember there are two items to be adjusted here. One of it is the drawings. The drawings, because these are sole proprietorship business, and also the profit or loss. And also the profit or loss. The profit or loss. Those are basically the two items to be adjusted to that capital. Yes. So therefore you can skip those the drawings. And then this one, rent rates and insurance is an expense. It will go to the statement of profit or loss on the debit side, but basically this one has to be adjusted. We take this and then we credit. To credit is to reduce. So we deduct this. So that is the final figure. Light heatings, heating and lighting is an expense. You can see it has an adjustment. And this is to be debited. To debit is basically to add. Yes. So then from there we have postage, stationery, and telephone is an expense. No adjustment, go to the debit side. Advertising is an expense, no adjustment, go to the debit column. Salaries and wages is an expense, no adjustment, go to the debit column of the statement of profit or loss. The credit losses, these are budgets which were written off, is an expense. It will go to the debit side, but basically this one has to be adjusted with this particular amount we add. That would be the final figure for the budgets which were written off. The cash in hand, this is an asset. It will go to our statement of financial position on the debit side. The cash at bank is basically an asset. Go to the statement of financial position on the debit side. the inventory at the start, this one will go to the statement of profit or loss. And where do we record opening inventory as per our formula? Opening inventory, this one. Opening inventory is a negative. So being a negative, it will go to the debit side. It will go to the debit side of the statement of profit or loss. This one will go to the debit column of the statement of profit or loss. So below that, we have receivables. The receivables, basically, this is an asset. It will go to the statement of financial position. And this one has a number of adjustments. So first of all, we take the original figure. The original figure, which is this one. And then we add this. So that's why it is on the debit side. We less this amount, which is on the credit side, this one. We less. And then I hope you can also be able to recall, we have the expected credit losses. Expected credit losses, as I said, is equivalent to the allowance for doubtful debts. So which allowance for doubtful debt do we less from the receivables figure? Is the allowance for doubtful debt at the end of the year. The allowance for doubtful debt at the end of the year basically will be equal to this one, the start, plus now the increase, this one. Or actually, we less both. We less at the start, and we also less what? The increase, this one. Hope you can see the receivables figure. There are a number of adjustments. There are these two errors which were made. We have one, this one should be added, this one should be deducted, and that's what we basically have done. And then we have deducted the expected credit losses at the start and also at the end. That's basically how we get the final figure for receivables. We get the final figure for receivables. And then from there, we have the property, plant, and equipment. The property, plant, and equipment, we are given that at cost. So basically, this is an asset. It will go to the statement of financial position. So where I recorded this, so this one should be here. The receivable should be here. Should be here there. Yes, because that is our statement of financial position. The debit and the debit column should be there. So I'm saying for this property, plant, and equipment is basically an asset. This will go to the statement of financial position. Statement of financial position is an asset on which side? The debit side. But this one will need to be adjusted with the, or actually we need to deduct the depreciation. So this will go to the debit side here, but we take the costs, and then we are going to less the depreciation. So I hope you can see in this particular question, unlike the other question which we did, we were not given the depreciation for the current year in the trial balance. But in this question, you're given the depreciation for the current year in the trial balance. It basically means that this particular accumulated depreciation we have at the end, this one, include this depreciation for the current year. So what we will do, we will take the cost minus the accumulated depreciation at the end. This one is at the end. So we will not less at the start. But I hope you can also be able to recall there was an error which was made. This depreciation for the current year was understated with 120. So therefore, we will less this, and because the depreciation for the current year was still understated, we also less this understatement. We also less this understatement because this was supposed to be more with 120. So that will give us the net book value at the end. So the accumulated depreciation, do we take this to the income statement or the statement of financial position? No. This one is adjusted in the plant and equipment. It's an net year adjustment, just like the expected credit losses. So then this depreciation for the current year, this is an expense. It will go to the statement of profit or loss. And basically, in this case, we take this plus the understatement, this one. We get the final value. And I think we are basically done with that. Let's go to these items of the adjustment. We see whether we have dealt with all. Yes, so for closing inventory, we have dealt with that. The prepaid insurance, this one will go to the balance sheet as an asset. The expense which is paid in advance is an asset. Go to the statement of financial position on the debit side. Below that, we have heating and lighting which were accrued. These are current liability. It will go to the statement of financial position on the credit side. We have the prepaid rates is an asset. You go to the statement of financial position on the debit column. And then from there, we have the increase in credit losses. So this one was is an expense here. And then number two, remember, it has been adjusted in what? In the receivables. In the receivables. I think we are done now. We are done. So I think what we need to do, two things. One, we compute the profit or loss for the year, and then from there we adjust the capital. So we adjust the capital. Let's first of all we get the profit or loss for the year. The profit or loss for the year, we said, should be the balancing figure in this account. So the statement of profit or loss, we said, will not balance. The difference should be the profit or loss for the year. The profit or loss for the year. Yes, you can see it's not balancing. The credit side is more. So we said the difference here will be the profit or loss for the year. And actually we said if credit side is more, then we have a profit. We have a profit for the year. A profit for the year. So what will be the profit for the year? The profit for the year will basically be the difference. The difference between these two totals. So this minus this one. So which will give us 22,138. So that will be the profit for the year. We record it here on the debit side. This one. Okay. That figure we must type it here manually. Let's type it manually here. It's basically 22,138 and 3 zeros like that. Yes, so you can see now our statement of financial position is doing what? Is balancing. So that is basically the profit for the year. So having this, then we need to adjust our capital here. Let's adjust this capital. So this capital will be equal to the original capital, this one, minus the drawings. The drawings, we have them here. So these drawings at the start, we also add this. We also less these drawings, which were not yet accounted for. So we have taken the capital minus the drawings at the start minus the drawings which were not accounted for. And then to this, I will also add the profit for the current year. This profit, I'll add it. So basically that now will give us the final figure for the capital. The final figure for the capital. Let's just enter. So we have the final figure for the capital, and then we do what? We balance this. We get the total. So this one should automatically balance. Let's see whether it is balancing. You can see it is automatically balancing. It is automatically balancing. It is automatically balancing. It is automatically balancing. Yes. So basically that is it. That how we do these particular questions. And if you check on the past papers, these questions are very, very common, especially that last part, the section 3. This question, you can see the other question which we did, this question which you have done, you can see there is no much difference. There is no much what? Difference. No much difference. But you can see if you understand this is a very, very simple question. It's a very, very simple question. This basically is a question you can be able to score all the marks. That in the position, is this question doable? Is it simple? Or is complicated? Please. The question here. How is this question? Kezia, Paul, Mwikali, Josephine, how is this question? Is the question doable or is it very much complex? How is the question here? So, and remember, this is basically something you need to understand, because all what is being tested here is one, are you in a position to prepare final accounts? Are you able to do the final, the AD adjustments? Are you able to prepare even the original trial balance? Remember this, what you have been doing in what you did in financial accounting, whatever you did in financial reporting. And basically, as an auditor, you must be able to know how to do this. Must be able to know how to do this. Sasa, yes, Josephine is saying it's very much complicated. It's very much complicated. �𝐍𝐻 is asking, what if we have an audit and tax question? Which one do you select? It all depends with the question, which is simple. That's why we say we are going to basically do both auditing and tax. It all depends with the questions you come across. You may come across a question in audit which is complex or maybe simple, or you come across a tax question which is not basically doable. It is a little bit complex. So you need to prepare both audit and tax. And you always do the question which you feel you are comfortable with. Sasa, you do the question which you are comfortable with. But you need to prepare both. But I feel that this is an area which is very, very simple, provided you understand it. So, but basically I've said, like person I did accounting in high school, we used to refer to this as 10 column worksheet, because I hope you can be able to remember there is something which you are not including here, the adjusted balance. That one is not captured here. So if we include that section for the adjusted balance, we should be having 10 columns. So the 2 columns for original balance, 2 columns for adjustment, 2 columns for the adjusted balance, 2 columns for the statement of profit or loss, and 2 columns for the statement of financial position. But because we are not including that section for adjusted balance, that's why by the end of the day you can see we have 8 what? We have 8 column. Yes. So basically that is it. That what was required as far as this particular question is concerned. I feel that this is one of the areas you can be able to score a clean 20 marks if you happen to come across this particular question. And I hope, I know we still have other questions which test on the same. I'll be able to check the past papers. If I get one, I'll be able to share that with you so that you do what? So that you use it as part of your revision. Sasa? Yes. So I think for today, we are going to stop at that point. So once we continue from there in our next class, we will be able to now proceed with our revision, because I think this was still part of the revision. Take into account is something we have done. So maybe the areas which you have not handled, because I don't think we have done 100% of the syllabus. So I think we are going to look on those, or we are going to cover on those areas as part of our revision. Like I've seen a number of questions in the past papers asking about the if function. I think maybe we are going to do something to do with that, and maybe any other area which I have not had. Maybe we will be able to create time within our revision. But maybe once we meet in our next class, we will maybe go back to the area of financial reporting, because we say this is one of the area which is tested in section 2, which we said is the questions in section 2, we say those are compulsory questions. So we will be able basically to do a question maybe from a number of questions. We will try and see whether we can be able to do like 2 questions from the area of financial reporting. Financial reporting, remember, we did a number of items. We looked on how to prepare cash flow. We looked on how to prepare the group account, how to present the financial statement, the analysis of financial statement, the ratios, the common size, the vertical analysis, the preparation of the projected financial statements, the data visualization, and also the preparation of the dashboard. So basically what you need to do even before we meet now in our next class, can you try to revise on what we did in that area of financial reporting? So we will try to look on to revise on a number of areas. So maybe I'll try to get more questions from the past papers. If I can't be able to get, I'll be able to borrow questions from a FAR. Because remember what we said is that, in fact, most of the questions which are tested from the area of financial reporting, most of them are borrowed from a FAR. Maybe even not be able to get a good question from the past paper, and basically be able to borrow a question from from financial reporting and analysis. So therefore, for today, let's stop at that particular point. We continue from there on which day? That is on Saturday, as we continue with our revision. Equally, if maybe you have a colleague who is basically preparing to sit for August 2025 exam is you feel not well prepared, maybe you can share this information with him or her that we started our blogs today. So maybe he can be able to join us. We are just charging an amount of 2,000, and that will enable him or her to be able to access all our revision classes. So you can share that information with your colleagues who are willing basically to join us. So have a good night. Let's continue from there. 𝐿𝐍𝐶 is asking, can they test cash flow? No. Basically, if you check on the syllabus, you just need to look on how to prepare cash flow of a single company, not the group one. Not the group one. Cash flow of a single entity. Equally, that topic of group, if you check, is basically it's the basic consolidation, not the aspect you covered in AFR. It's just the simple normal consolidation. Sasa, yes. So have a good night. Let's continue from there tomorrow. Not tomorrow. That is on Saturday. Have a good night.